Hey, good morning, everyone. Marty Missouri here, Friday, the 13th of January, 2023, with your weekly economic update. And I am going to close with a look at the S&P 500 index and the VIX index this morning. In front of you is our PWA index, simple graph. Need to load up my drawing tool here. And if you look real closely, you can see an uptick right there. Our overall score went back up 2 points to 33.33, still decisively in recessionary conditions. The way we do this, or the way we read it, is that this reading below zero, notably below zero, denotes recession risk in the offing, exceeding the odds of continuing expansion. Our view is that we're getting close, the first half of the year. Some people who are in the recession camp say second half of the year, and as far out as 2024. We think it probably is happening sooner than that. I appreciate the other theses and the logic behind them. Of course, we may not have a recession at all. That's always a possibility as well. But we're in that recession camp. Actually, we had quite a bit of movement, good and bad, and I'll share with you a handful of those inputs. Starting with retail sales. Now, we get the number everybody watches out once a month, but Redbook does a weekly survey, and as you can see, the rate of growth there has been dropping notably. This last week, we dropped to just 5% week over week increase. And again, still retail sales going up, but going up at a slower pace, something to keep an eye on. The consumer credit data came out this week, and I wanted to show you just overall consumer debt. It rose by almost $28 billion here this last month. I want to pull in right from the Fed's own website and just kind of look at trends there. Now, the bulls on the economy continue to cite the strength of the consumer, and I get that. A good friend of mine and I were just having that conversation about how tough it is to get into a restaurant at 5 o'clock on a Friday these days. And so what you want to pay attention to is, are people spending? And then how are they funding that spending? Now, typically an economist would say that when revolving debt is going up, that says good things about the economy because people are confident enough to go out there and spend, and I get that. But what we're seeing, and I don't have this loaded up, but I've showed you that the savings rate among consumers has dropped to the floor practically. And as you can see, revolving debt here, now this is November, this is slow in terms of, it just came out this week, but it's for 2 months back. But as you can see what the trend has been there. Hopefully it's discretionary consumption, but there's other evidence out there that people are maybe having to hit their credit cards just to take care of some basic needs, right? So you see that happening in there. Percentage increases, total increases, that sort of thing. Total outstanding debt, right? Continuing to go up here. Here you are all the way back to 2017 to current. So just saying, one thing that when we look at the consumer and we look at the strength of the consumer, which is part of our mild recession thesis, because the consumer does still have a pretty good looking balance sheet, we are paying attention to where the source of the funds for this consumer spending holding up so far. Where is that coming from? Okay, while people are increasing their overall debt, they're definitely not going out there and mortgaging the purchase of a home of late. You can see that continues to drop quite notably, and of course that is not a positive indicator about the state of the economy. Consumer confidence, however, the University of Michigan survey actually came out, and it was above expectations. Again, we're still, historically low, but you want to look at trends and rate of change, and that's a positive. I found that interesting in terms of the market reaction. Now, there's still a couple hours left in today's trading session, but the market was down quite a bit earlier on, and it rallied back to even, and now a little bit in the green, coincident with the release of the University of Michigan survey. And again, why I find that interesting is because if the consumer is feeling more confident and they're getting out and spending, we're going to score that as a positive as it relates to the overall economy. As it relates to the equity markets, which is what I'm talking about here, and how the equity market has been trading of late, the instinctive position that I would go to is that the market would sell off on a stronger than anticipated consumer sentiment reading, right? Because of the Fed and the Fed wanting to keep kind of a lid on animal spirits and keep inflation at bay. Now, it could be, from what I understand, I haven't read the report, but I've looked at a couple of headlines, that near-term inflation expectations are really coming off the boil. And the Fed puts a lot of weight on inflation expectations. When expectations are high, inflation tends to rise with expectations. When they're low, it tends to fall with expectations. However, longer-term expectations, like say 10 years out for the consumer, are still elevated, notably above the Fed's 2% target. So square it all up, and I'm a little skeptical about today's big rally off the bottom. I'll tell you, it wouldn't surprise me to see the market roll over the next couple hours. No reason that has to happen. There's a lot of under the surface, options action going on, and we're going to speak to that here at the end. That actually could provide more support for the market, at least up until this big options expiration here in a week. So there may be some of that going on as well, and I've showed you here on previous videos that the short-term technical setup has actually been very positive. So it's not that I should be surprised by this rally given the technicals. It's just that I'm a little surprised given that that was better than expected data. The market rallied on that. That would imply that the market is starting to get more concerned about recessionary risk versus Fed risk. And I honestly don't think we're there just yet. So I think there's something else going on, and I'm skeptical as to its sustainability. But we'll see. Of course, I'm going to update you as we go. Initial jobless claims continue to be a very positive indicator. As you can see, this was concerning relative to what it usually looks like going into recessions, and here we are rolling over. That's an unambiguous positive about the state of the economy, but you've got to keep in mind that, employment data across the board, which has been okay, is lagging data. This tends to shift in a hurry, and as you can see, when it shifts in a hurry, typically recession follows. But we'll score it as it is, and right now that's a good-looking trend. Cass freight data rolling over hard, a very recessionary look in terms of shipments, and as you would expect, the expenditures are coming down as well. That's a good look relative to inflation. That's a bad look overall relative to the state of the economy. The CPI data came out this week. It really came in line with expectations, right? It was expected to be down 0.1% month over month. That's about what it was, down 0.08%. Off the boil a bit more, down year over year, 6.45. When you X out food and energy, which is this look here, still very high relative to history, 5.71%, and actually up on a month over month basis at 0.3%. So certainly nothing there which would tell the Fed to quit worrying about inflation, right? But we are seeing slowing in the data. We are seeing softer talk from some Fed governors. Some are trying to remain hawkish. We may actually get a quarter point hike as opposed to a 50 basis point hike in February. If we do, I think it will be a hawkish 25 basis point hike, meaning it's less than what the market had previously discounted, but I don't think the Fed wants to remotely signal the all clear for the market. So if they only go 25 bips, they are going to pound the table on, their narrative. Like, for example, we're not cutting rates in 2023. So we'll see. That'll be interesting here in a couple of weeks. Copper has exploded higher of late. Now, that would be inflationary. Of course, folks, this is easy. This speaks to what we've been talking about. These are all notes that I was throwing at certain spots related to China. The Chinese government is 100% in on boosting the economy with stimulus this year, and they tend to do it in ways that is very bullish for copper. We've been talking about this for a long time. And by the way, China coming back also is part of our overall mild recession thesis because, of course, of the impact on the global economy, including the U.S., if the second largest economy in the world is actually doing okay. The Baltic Dry Index paints a very different story about the state of the global economy. It is just rolling over here of late, quite notably. Okay, so that's good news relative to inflation. That's the cost of shipping goods across the waters. but it doesn't speak well of the state of the global economy if there's not a lot of demand for pushing goods over the world's waters. The latest on the consumer staples versus consumer discretionary ratio, right? That's been going up and up and up. I think I showed you that last week. Well, this week it absolutely rolled over. I mean, Disney has done really well. Amazon has done really well. And those are big components in the consumer discretionary space. So when this goes down, that means discretionary stocks are outperforming staple stocks. And if the guts of the market speak to the economy, then clearly this is saying that we may very well be wrong in our near-term recessionary thesis. And we're open to that possibility, believe me. So something we're paying attention to. When we square it all up, we're still notably in the red, but I just showed you a couple indicators that turned green for us. So we'll keep a close eye on those. Okay, so let's jump to the stock market. First of all, we'll just do the S&P 500. I have loaded up here the hourly chart. So this is a 60-day, 60-minute chart. And you can see since I've talked to you last, we've had a rising wedge pattern developing here, very distinct, with, call it, bearish divergences. If this is flat, if we're not continuing to keep up with the momentum, that's suggesting that the momentum is going to die. And it did. That was that gap down. But as I mentioned, we came right back up, and that's coincident with that consumer confidence data. And right now, the market is continuing. The S&P is up 14 basis points. The NASDAQ 100 is up 35 basis points. And yeah, something to pay attention to. Right now, though, remember, I was very bullish right in here, and we got that big pop. I'm not feeling very bullish right here, despite what we're seeing in the market today, folks. So obviously, what I'm suggesting is that we could very well see the market sell off here over the next few days and weeks. Remember, the daily chart was looking very constructive. Remember, Wednesday, I spent a lot of time on this reverse head and shoulders pattern, which continues to play out. It becomes official when it breaks through that neckline. So typically, in a reverse head and shoulders, which is a bullish pattern, you come through here, you break the neckline, then you come back and you test it. And once you pass that test, technically speaking, then you're off to the races and, bear market over, right? So obviously our base case is that this will end up being a failed reverse head and shoulders, but right now we got to see it for what it is. Remember, we had just closed above the 50-day moving average on Wednesday, and right now we are threatening to close above the 200-day moving average. That's bullish, right? But that's been really strong resistance. You can see we closed above it, early on during this bear market, notable times, always to end up failing and then failing the subsequent retest, like right there. Right here, back in August, the 200-day overlapped with the bear market trend line, too much for the market to overcome. And here it tried it, lost it at the trend line, tried it, lost it at the trend line. So if what I just showed you in the hourly chart makes sense, then we could again see it lose it at the bear market trend line once again. So you've got some pretty stiff resistance there. But I got to tell you, you got a buy signal here on the MACD, and there's nothing wrong here. It's not like I can show you negative divergences like I can on the hourly chart. The hourly chart is setting the stage for that. But right here, if all we were doing is looking at the daily, we'd say, bulls have a good, strong case to make here. And even as I speak, the market rally is accelerating a bit. Okay, one more thing I want to show you, keeping you a while this time, but I think this is interesting. This may look familiar if you've been with me on the videos over the last year. This is the VIX index I track. We track the spot VIX and 8 futures, but right now we're just looking at the spot. That's the green line, right? So, folks, when we have breached 20, right, through this entire bear market, it's been coincident with a test of that bear market trend line. So this is the S&P down here. So volatility is just getting sold big time. I would say right here it's oversold. And what that suggests is that there's a lot of room to buy volatility, right? Buy put options and short stocks and yada, yada. Dealers, when they sell the puts and they hedge, that's by shorting. So that can exacerbate something to the downside. So folks, one of these days, I'm going to be looking at this kind of data, and we're going to be breaking through the bear market trend line. This could be it, and on our way to a new bull market. I'm not making that call right here. Why? Because of what I just showed you about general conditions, right? That means that earnings are actually going to come in a lot lower than the market is currently discounting if we do have a recession and so on. And that clearly there's the risk of much more pain to come, and probably below this 3,500 mark, before we're feeling really, really good and want to add to our risk in our core portfolio. So I'll leave it right there. Thank you, folks, as always, for watching and listening. Hope you have a wonderful weekend. Talk at you next week. Take care. Bye-bye.